Accounting for subsidiaries, joint ventures, they are all out of scope. Now, it may happen that the standard that deals with accounting for subsidiaries in the separate financial statements says that you can go back and account for them under 109. That is a different logic tree to be followed. Step 1, go to the standard. Do you have guidance? You have guidance. So by default, accounting for investments in subsidiaries is out of standard. Rights and obligations under leases. Right now, Ind AS 116 deals with the accounting of a lease liability, a lease receivable, creation of an ROU. It gives guidance about at what rate it is to be created, in how much amount it is to be created. All of that is within Ind AS 116. So, rights and obligations under leases, they are out of the scope of Ind AS 109. However, if one read Ind AS 116, Ind AS 116 is silent on how do you do provisioning if a customer is not paying lease rentals, or if there is a lease rental discounting, how do you account for that transaction? Now, those standards are, or those transactions are not covered under Ind AS 116. For those transactions, we come back to Ind AS 109. And that is why you see that rights and obligations under leases are out of the scope of 109. However, except derecognition, impairment, and embedded derivatives. So what happens if a lessee does not pay rentals on time? The impairment of those receivables in lessor's books is covered by 109. So that is an important point to keep in mind. Some parts could be within scope, some could be out of scope. Employers' rights and obligations under employee benefit plans. Again, this is out of scope of 109 because basically the accounting for plan assets is under the Ind AS 19 standard on employee benefits. Insurance contracts are also financial instruments because in some way it's like a guarantee contract where if an event happens, the insurance company or the insurer has to pay out money. So it's a financial instrument, but separate standard deals with it. That is out of scope. We spoke about share-based payments. There is another one around business combinations, revenue recognition. We'll look at those as well. Yeah, so we spoke of share-based payments. Obligations under share-based payment transactions out of Ind AS 109, exclusions. Now in a business combination, there could be a forward contract between an acquirer and a selling shareholder. So basically, company A can tell company B, 6 months later, I will buy all the shares of your company and pay you 100 crore rupees in cash. Is it a financial instrument? Of course it is. But there is a separate standard Ind AS 103 on business combination that deals with the accounting for those transactions. And that's the reason why it is considered to be out of scope of Ind AS 109. Rights and obligations of Ind AS or arising in Ind AS 115, again out of scope. So as we said, if there is work in progress, first go to Ind AS 115. If Ind AS 115 covers the guidance, account for it. But if there is unbilled revenue, for example, Ind AS 115 may tell you that you come back to Ind AS 109, especially if the billing is only a formality. Loan commitments, for example, you could have a situation where you promise to lend to someone at a future date. That is again outside the scope of a standard unless you choose to fair value those. So this is broadly what is out of the scope of the standard. Again, two themes are coming out of this. There is a specific standard and hence scoped out, or partly scoped in because the other standard does not have complete guidance. Is everyone with me? If you have any questions, maybe I'll just pause for a minute here. These are specific exclusions. Yeah. Okay. Now, there are certain items which can be additionally included within the scope of the accounting standard. Now, what are these? I'll take an example and then go to the slide. let's take an example of a company which is going to manufacture chocolate, right? So today the company says, I want to buy cocoa because cocoa is a key input in making chocolates. I'm going to buy cocoa 3 months later. So today I've entered into a firm commitment, or I have entered into a contract. I have issued a purchase order to my supplier that please, after 3 months, deliver cocoa to me at a price which I have agreed today. Right now, would we account for this transaction anywhere in our financial statements? Any quick thoughts? Once again, I'll keep the chat box open. Absolutely right. We will not account for that in the financial statements. It is an executory contract. It is a contract where neither parties have fulfilled their promise in the contract. Those instruments are not covered in the scope by default. However, the standard specifically allows them to cover them within the scope if the company wants to take a choice. So basically, to take the full picture of this transaction, I placed an order to buy cocoa. Today, it's an executory contract. But my risk management strategy tells me, look, price of cocoa could keep fluctuating. Price of cocoa could keep fluctuating. To lock in my prices, why don't I enter into a forward contract to lock in the price of cocoa? So I enter into another derivative to hedge the risk of change in price of cocoa. Say a futures contract. Now, think of the accounting implications. On the one hand, you have a derivative which will trigger accounting. On the other hand, you have an executory contract which basically is the source of the risk, which does not trigger accounting. To solve this mismatch, Ind AS 109 specifically allows companies to choose to fair value this kind of an executory contract. Right? So that's the one exception where it's not by definition a financial instrument, but it is within scope. Okay, there was a question around loan commitments. Basically, a loan commitment is that, say, a lender today tells the borrower that I will commit to give you a loan at this specified rate of interest. You can avail this loan at any time in the next 6 months. Now, remember, in most of our loan clauses, we have a condition that if your credit performance deteriorates, the lender can unilaterally cancel that right. Basically, lender gives a window, but says at the end, it is my discretion. But there could be loan commitments where that discretion is taken out. Those loan commitments are generally fair valued and hence out of scope of the standard. There's a question on, should there not be an underlying asset or a liability for even entering into a derivative contract? Absolutely, the RBI or regulation would not allow anyone to enter into certain contracts with banks if you don't have an underlying. In this example, the underlying is a contract, is a purchase contract or a purchase order that I have placed. It's a transaction which will occur because I have past performance of this contract. I have imported quantities of cocoa in the past. Right, so those are some of the scope inclusions. Sorry, I'll go back to the scope inclusions. Contracts to buy and sell non-financial items, which otherwise would have got exemption, like an executory contract. Impairment requirements of receivables under Ind AS 115, they are within the scope. Again, because revenue recognition standard is silent on how do you account for this. Okay, let's take